The RBA has hiked the cash rate by 25 points. Let's have a look. Hello everyone, Florian here and welcome to another episode of HeiseSays. Grab your stein of afternoon coffee because we're going to discuss the RBA hiking the cash rate by 25 points. Now I've had to update this chart. You can see here it's now at, 3.35%. So it didn't, Combank were off the mark. They didn't go with a 0.4 or a 40 basis point hike. They just lifted it up to 3.35%. Now let's start by, before we jump in what the RBA has said, let's start by having a look at what you, the viewers, have said. I put a poll up yesterday. I got 1,600 votes. Hey, that's bigger than a Finder sample size for a lot of their surveys. But anyway, and 2% voted 0% increase. So 2% of those of you that voted said there'd be no RBA rate increase today. So you were wrong. 3% voted 0.15 or 15 basis points. They were wrong too. Now the majority at 57% voted for 25 basis points or 0.25%. You were all right. Congratulations, you got it right. 16% voted for 40 points and 22% voted for 0.5% or above. We have a look at some of the comments here. Definitely should be 4 at least. Time is not on the RBA's side. From William, high enough to ensure all of the bankers get a 100% bonus increase this financial year. Guess the RBA move. This is more fun than the Melbourne Cup and first Tuesday of every month except Jan. There you go. You're right. That is kind of like what it is. Lee is going rounded up to 3.5 would be nice. That's what I was kind of hoping, that they would go really hard with a bold move and then just wait and see for a few months. The impacts scare a lot of people. But anyway, so let's jump back and have a look here at the statement from the Reserve Bank. So a statement by Philip Lowe, the governor, and regarding the monetary policy decision. Okay, you can see that. Let's get my highlighter here. At its meeting today, the board decided to increase the cash rate target by 25 basis points to 3.35%. It also increased the interest rate on exchange settlements by 25 basis points to 3.25%. Global inflation remains very high. It is, however, moderating in response to lower energy prices, the resolution of supply chain problems, and the tightening of monetary policy. Hey guys, do you remember when they said that it was just transitory inflation? Remember that? Or was it Yellen in the US? I remember that back in the day. It will be some time, though, before inflation is back to target rates. The outlook for the global economy remains subdued, with below-average growth expected this year and next. In Australia, CPI inflation over the year to the December quarter was 7.8%. The highest since 1990. In underlying terms, inflation was 6.9%, which was higher than expected. Global factors explain much of this high inflation, but strong domestic demand is adding to the inflationary pressure in a number of areas of the economy. Inflation is expected to decline this year due to both global factors and slower growth in domestic demand. The central forecast, so they've got a when they're saying this, they've got a high forecast and a low forecast, the middle one. I'm assuming this is the probability-wise, it's the most likely forecast. You'd assume. Anyway, the central forecast is for CPI inflation to decline to 3.75% this year and to around 3% by mid-25. Mid-term inflation expectations remain well anchored, and it is important that this remains the case. The Australian economy grew strongly over 2022. The central forecast is little changed from 3 months ago, with GDP growth expected to slow to around 1.5% over 23 and 24. The recovery in spending on services following the lifting of COVID restrictions has largely run its course, and the tighter financial conditions will constrain spending more broadly. The labour market remains very tight. The unemployment rate has been steady at around 3.5% over recent months, the lowest rate since 1974. Job vacancies and job ads are both at very high levels, but have declined a little recently. Many firms continue to experience difficulty hiring workers, although some report a recent easing in labor shortages. As economic growth slows, unemployment is expected to increase. The central forecast is for the unemployment rate to increase to 3.75% by the end of this year and 4.5% by mid-2025. Wages growth is continuing to pick up from the low rates of recent years, and a further pickup is expected due to the tight labor market and higher inflation. Given the importance of avoiding a wage spiral, the board will continue to pay close attention to the evolution of labor costs and the price-setting behavior of firms in the period ahead. The board recognizes that monetary policy operates with a lag, and that the full effect of the cumulative increase in interest rates is yet to be felt in mortgage payments. There is uncertainty around the timing and extent of the expected slowdown in household spending. Some households have substantial savings buffers, but others are experiencing a painful squeeze on their budgets due to higher interest rates and the increase in the cost of living. And there are daily articles appearing about this now. Which, I mean, you can feel sorry for some of these people. You wouldn't want to be in that situation. But how many of them have gotten to this into the mess themselves? But you can't blame them. It's the culture of FOMOing into housing here in Australia, isn't it? Borrowing too much. Household balance sheets are also being affected by the decline in housing prices. Another source of uncertainty is how the global economy responds to the large and rapid increase in interest rates around the world. These uncertainties mean that there are a range of potential scenarios for the Australian economy. The board's priority is to return inflation to target. High inflation makes life difficult for people and damages the functioning of the economy. And if high inflation were to become entrenched in people's expectation, it would be very costly to reduce later. The board is seeking to return inflation to the 2 to 3% range while keeping the economy on an even keel, but the path to achieving a soft landing remains a narrow one. The board expects that further increases in interest rates will be needed over the months ahead to ensure that inflation returns to target, and this period of high inflation is only temporary. Oh boy. Oh boy. Some people are gonna get... Damn. Remember, interest rates won't go up until 2024. I just did some paperwork today. I had to write 2023. People believed it. They believed it, guys. In assessing how much further interest rates need to increase, the board will be paying close attention to developments in the global economy, trends in household spending, and the outlook for inflation in the labour market. The board remains resolute in its determination to return inflation to target and will do what is necessary to achieve that. Now, let's just remind ourselves what the board did, how low they bought the cash rate, everyone. Let's not forget that. We can't forget that. Okay, they bought the cash rate so low, guys, to intervene, to prop up the economy, to save everything. And if we have a look here at this, we've got to remind ourselves of what the government did. They kept the zombie companies alive. Now we've got a construction apocalypse where they're falling over. You've got JobKeeper. So many people were just being supported, and this is all racking up huge amounts of debt for that we're all going to bear the burden of. You got 3% was considered an emergency rate. They went down to 0.1%. This is going to get messy, guys. It's certainly going to get messy. So let's have a bit of a talk about that. So there we have it. The cash rate is now at 3.35%. This has been, a once in a generation shift in the cash rate. Well, even the crash down to 0.1% was nuts. The question is, are we going to hit 4.5% this year in the cash rate, or are they going to pause and hold? They've said more increases are coming. More increases are coming. And I haven't looked at any of the reporting from the banks, but I'd bet you a carton they're all going to pass on this 25-point rate. It's going to be tough for some people. I think the hardest ones hit are going to be the ones who just jumped in the market, FOMO'd in. I'm hoping Perhaps naively, I'm hoping it just means a change in quality of life. It means the luxuries, like coffee at the petrol station, those luxuries, they're all going to have to be abandoned. People are going to have to really tighten their belt. And you'll start to see it manifest in some discretionary retail spending. You're going to have to find another $1,000-2,000 a month. It's not impossible, but it's going to suck for a lot of people. And I wonder if this will change the way they, how they trust those in positions of authority. Anyway, guys, thanks for watching. Thank you for commenting on my poll, and I'll see you in the next episode. Check out Heise BIM and Heise Does for other videos and topics I discuss. If you want to support the channel, you can financially on YouTube or Patreon. Use our referral links, buy our pocket squares, or call us if you need an architect. Take care, everyone. Have a great day. And, well, we'll just have to wait and see what happens next month. Do you reckon they'll raise rates again straight away? Or it looks like they're not taking a break. They're just hitting it hard. Do they even care about the lag? Oh, boy.